Okay, let's start. I think that this is probably a good time to start. Welcome all to our global webinar. We'll try to give you a rundown of the main events that shaped currency markets and the world of finance and economics in the year 2022. And we'll try to give you some preview of what to expect for 2023 and what will be the main factors driving markets then. Okay, if we go to the first slide with the contents, we will, like we said, we will cover 2022 with the main events, the main factors in markets, and we'll pay particularly close attention to what we call the big three: sterling, euro, and dollar. What's going to happen with euro dollar? Is parity a thing of the past, or we will revisit the lows? What will happen to sterling after an extraordinarily volatile year? We'll try to give you some view of what we think of the chances of a global recession on the way. We'll give you a spoiler. I think that that most people are too pessimistic about the economy. And we'll finish by giving you a rundown of the main things to look out in 2023. And then we'll have some time for questions and answers, and we'll do our best to answer your specific questions. So on to the 2022 recap. Well, it's been one of the most challenging and volatile years for currency strategies for some time. For the first time in decades, global inflation has become not just a factor, but perhaps the main factor driving monetary policy, currency markets, and markets in general. Central banks all over the world have had to raise rates more aggressively than they've had, I think, in some cases in history. In the US, for instance, the pace of hikes that the Federal Reserve implemented this year is the fastest in history. As a result, investors are concerned about recessions, both because of the impact of this rapid tightening in monetary policy and because of the impact of inflation in consumer confidence and real consumer spending. And as it's not surprised that it has been the most volatile currency trading year, definitely since the great financial crisis in 2008, 2009. If we were to select two factors that describe what happened last year, the first one would be a massive US dollar rally that peaked in September before it retraced some of its gains. This is due to the Fed being among G10 central banks the first one to react and the one that reacted most aggressively to this inflationary surge. And the second and perhaps less noticed factor or development for 2022 has been that emerging market currency have actually performed much better than they typically do in this rise and ride environment. In fact, somewhat surprisingly, so far, the biggest performers year to date is not the US dollar, it is the Brazilian real and the Mexican peso, which is not something that you're used to seeing in environments where the Fed is hiking rates. That tends to be, in the past, that has been very negative for emerging market currencies, and this year has been the exception. Most major emerging market currencies are up, if not against the dollar, definitely against the euro. If you go to the next slide, let's talk a little more in the detail about the surge of inflation. Levels of inflation remain sky high. We're starting to see in the US the first signs of a downward trend. They're still very low. It's still unacceptably high, but it's no longer rising, and the key indicators are starting to drop. But nevertheless, let's not forget that we are everywhere at rates of inflation that a year ago would have seemed almost impossible to believe. As a result, central banks have tightened policy aggressively everywhere, some places more than others. The Fed leading the way among G10 central banks. But in general, rates are much higher than anybody expected them to be just 12 or 18 months ago. What has caused this spike in inflation rates? There's several factors. There's a lot of debate about which ones are more important, but clearly the supply-demand imbalances after the pandemic, the stretched supply chains, the difficulty sourcing materials due to pandemic restrictions, was one of the initial factors back in 2021. The fact that we come off a period of just record accommodative fiscal and monetary conditions, to me, that's by far the most important one. The fact that we have 0% rates combined with enormous deficit spending by all the major in all the major economic areas. And then an additional energy price spike on Russia-Ukraine war. To me, this is probably the least important of the three, though it is very important in Europe. And the reason for that is that, frankly, the oil prices worldwide are now below where they were before the Russia-Ukraine war. But nevertheless, it perhaps the initial spike in oil prices, and they're still very high, natural gas prices and electricity prices in Europe have added to the inflation psychosis. Perhaps the best indicator of how big of a surprise this has been is the Citigroup Inflation Surprise Index. This is not an inflation index. This is an inflation that tells you the difference between the numbers of inflation that are coming out and what strategists, the average of the consensus of economists expected them to. And you see that we've had not just record high inflation, but record high surprises, upward surprises in inflation throughout 2021 and 2022, and only lately have the numbers come down. And in fact, now we're getting some negative surprises in inflation, meaning inflation is coming out lower than expected, as we have seen today in the CPI report. That was very good news indeed for the Federal Reserve and for markets in general. If you go to the next slide, again, to emphasize that however good the news from the last couple of reports in the US, including the one today, the one we got today, this easing of inflation is not seen everywhere. The inflation overshoots are huge, with the potential exception of Japan, and even in Japan, inflation is already above. Is already clearly positive. The UK is said to suffer the largest inflation overshoot. That probably has a lot to do with the weakness of sterling and the fact that that UK is a country whose economy is very exposed to prices. Same for Sweden. These are relatively small integrated economies that depend on imported goods and have seen their currencies suffer significantly. Again, this graph tells you what the difference between the CPI numbers and the central bank target. It is positive everywhere, including Japan and Switzerland. The red dot is the IMF projection for 2023, what that overshot will be. But frankly, given the track record of these models, I would be very wary of, I would not put too much trust in what the IMF is telling us that inflation will be. The fact of the matter is that right now, every single country in the G10 has inflation that is considerably above the inflation target of the respective central bank. That suggests that tightening cycles are not over yet, that we're still going to see continued hikes into 2023. And it's not at all clear to me when you're going to be able to see interest rate cuts, at least in the G10. Go to the next slide. Every single bank in the G10, with one glaring exception, the Japanese central bank, the Bank of Japan, have raised rates aggressively this year. They've been led by the Bank of Canada and the US Federal Reserve. The Australian, New Zealand Central Bank have been next. Again, after today's inflation surprise, maybe we can see that both the Federal Reserve and the Bank of Canada go into wait and see mode. We're still, but this chart makes it clear that places like most of the European central banks still have a way to go before they catch up to the level of hikes that we have seen in the US and Canada. Some of them, notably the Bank of Canada, RBA, Norges Bank, and possibly the Federal Reserve tomorrow, are already carrying out what we call dovish pivots to telling markets that they can stop hiking, and wait to see if the latest, more hopeful news on inflation do materialize in 2023. But we do not think that banks in Europe, with the possible exception again of the Norges Bank, can afford to relax just yet. We go to the next slide. So, as a result of this hikes everywhere and these inflation surprises and the general impact of inflation in consumer incomes, there's been a lot of talk about recession risk in markets next year. In Europe, particularly, in addition to the tightening monetary policy and the impact of inflation on consumer incomes, energy prices have spiked. This is a mostly European phenomenon. A fourth factor is that the Chinese economy has slowed down significantly due to it being the last major economic area in the world where COVID-19 lockdowns and restrictions are still a significant factor. As we will see, we think these fears are overdone. Labor markets everywhere remain very strong. Interest rates everywhere are still below inflationary level, which has traditionally been stimulative for the economy. Fiscal deficits remain high everywhere. It is hard for us to see how you can get any but the shallowest kind of technical recession in these conditions. But we'll talk about this in more detail later. If you go to the next slide. This has probably been the key chart. If you're going to look at one chart in currency markets, it should be this one, the massive rally of the US dollar, record rally, really, as of September, 18% year to date. I think that is one of the, if not the largest 9-month rally. Since then, it has dropped back. It has given up a substantial part of the gains. The driver for this rally, of course, has been that the Federal Reserve has led the G10 central banks with 375 basis points of hikes. Another 50 basis points hike expected tomorrow. So that will be 4.25% of hikes in less than a year. That is, I believe that is an all-time record, albeit it started from a very low level, a level of 0. But nevertheless, it's not surprising that the dollar has rallied as strong as it has, given especially that other G10 central banks have so far lagged the Federal Reserves in aggressive moves. In addition to that, fears of recession typically trigger flows to safe havens. And the safe haven we have seen clearly continues to be the US dollar. The rally has put the US dollar on course for its best annual performance since 2014. It is possible that it will give somewhat of the gains that it had not so far this year after today's very positive, in the sense of lower than expected inflation surprise. But still, even a 10% rally would be a significant move for the US dollar over 1 year. And we go to the next slide. Of the best of the rest in the G10 has been, somewhat surprisingly, perhaps, the Swiss franc. The dollar has also rallied against the Swiss franc, but the Swiss franc has outperformed every other G10 currency. The main reason for that is that the Swiss National Bank uncharacteristically led European central banks in carrying out a policy U-turn in the summer. It was the first big hawkish surprise, where they raised rates by surprise, while they would still talk about whether the European Central Bank would need to increase rates at all. Major European currencies have underperformed. The Norwegian kroner, the Swedish kroner have notched the worst performance in Europe. This probably has to do with the fact that both of those currencies are seen as the most leveraged to the economic cycle, and so they have been punished the most by markets that were wary of the chances of a recession in Europe. They've also probably, if, as and when those fears of recession are unwound, you would expect the Swedish krona in particular to be an outperformer on the way up. Sterling, in spite of all its massive volatility, has not been the worst performer. It has only underperformed the euro by a couple of percentage points. It didn't look likely just a few weeks ago amid the turmoil caused by the disastrous Liz Truss budget announcement. But right now, it looks like sterling may end the year in line with other currencies like the Canadian dollar or the European or the euro. By far, the worst performer has been the Japanese yen. This has been a massive reversal because typically the Japanese yen with the Swiss franc and the US dollar act as safe havens and react to fears of recession by rising. Instead, this year, the Japanese yen has dropped tremendously. Obviously, the reason here is that the Bank of Japan remains the only major central bank worldwide to not hike rates, and in fact has adopted an ultra dovish stance. It has welcomed inflation. In fact, unlike all the other central banks, it seems to be very happy with high and rising inflation, and it's not surprising that the currency has suffered. But nevertheless, it has been a major regime shift for the Japanese yen, that it no longer acts as a safe haven when markets fear recession. So with this, I think I'll hand over the baton to my colleague, who will talk about Latin American currencies, the surprise winners of of the 2022 year.
Thank you, Enrique, and good afternoon to everybody. So Latin American currencies have outperformed other currencies in the emerging market spectrum. Aside from the Russian ruble, the currency that we stopped forecasting, as we cannot really tell what is driving the currency at this point, and it's not really used in global trade anymore. The situation in the EM market spectrum has been quite interesting. Looking at the best performers, we clearly see that the Latin American currencies definitely take the throne. Brazilian real, Peruvian new sol, Mexican peso, and Chilean peso have been on top. And why is that? So one thing is that they are relatively, they have limited exposure to the risk events that have caused other currencies to suffer this year. So one such event has been the war in Ukraine. Obviously, a number of those countries are commodity exporters, and they actually benefited from this increase in oil prices and in commodity prices that resulted from Russia's full-scale invasion of Ukraine. Also, looking at the interest rates, those countries tend to have relatively high interest rates compared to other EM countries. It is not difficult to find countries in the Latin America that have high real interest rates, high and positive interest rates. Real interest rates have been a rarity for the past few quarters. Right now, it is starting to slowly shift, but still, if we are talking about the present rates, not at the ex-ante rates, which take into account the forecasted inflation, in many places, real rates are deeply negative. Looking at another region, Asia, we see that the currencies have been largely in the middle of the spectrum. Asian currencies have low exposure to war in Ukraine, so they did not suffer particularly because of the risk of sentiment, because the risk to their economies from that event was limited. Although they have suffered from a deceleration in economic growth in China, continued worries with the COVID-19 pandemic in China, and the Chinese very strict response to the pandemic. Generally, those currencies also have a relatively limited volatility, so even in typical times, you would expect them to be somewhere in the middle. But we can say that a few factors balanced out in 2022. So low exposure to war in Ukraine, but also a high exposure to slowdown to China. Many currencies in Europe have suffered quite substantially. Because of the closeness of war in Ukraine, we saw a significant volatility and significant sell-off in currencies such as the Polish zloty, Hungarian forint, for example. Also, a number of currencies have suffered from certain idiosyncrasies, internal issues. Best example that I know of is the Turkish lira, which sold off by almost 30% against the US dollar because of unorthodox policy, monetary policy and economic policy in Turkey. But also we are seeing some issues in other countries such as Hungary, which is suffering with a very high inflation and increased macroeconomic imbalances. In general, however, EM currencies have held up overall relatively good in 2022, considering the sharp appreciation of the US dollar. We think that the main reasons for that have to do with the aggressive tightening that many of the central banks in the EM countries engaged in, and also high commodity prices that certain EM countries are exposed to, particularly in Latin America, but also a number of other economies, such as South Africa, for instance. And let me right now pass on to my colleague. We'll talk about the dollar.
Okay, thank you. Thank you, Roman. Well, again, one of the two big stories of the year in 2022 is going to get a slightly different ending that is seen just a few weeks ago. The US dollar seems to be in retreat from what was the sharpest rally in its history. It has lost, by now it's probably, after today's numbers, it's probably about half of the gain that it made during that time. Still up about 9 to 10%, but still an impressive rally. But clearly, this rally followed by this fall is one of the most volatile moves that we have seen. The main reason for the correction is that in the US, unlike most other G10 countries, US inflation, the inflationary pressures appear to be easing. Now, it's definitely too early for the Fed to claim victory. I mean, we're still talking about inflation, annualized inflation over the last 12 months above 6%, which is unacceptably high. But the October and November CPI inflation, two reports came in considerably shorter than expectation. Right? If we look at my favorite indicator is the running 3-month average of the core inflation index, which excludes the volatile food and energy components, and that has dropped slightly below 4%, which is still much higher than the 2% target, but we now have a clearly established downward trend over the last 3 months. This probably seals the case for a slight dovish pivot from the Fed in this meeting tomorrow. We'll see a 50 basis point rate hike instead of the 75 basis point rate hikes that we have seen in the last few meetings. The question is, what are the Federal Reserve's communications as to when the tightening is expected to end? We think that after this downward surprise in the inflation number, it's possible that we'll get no more than one hike, and then the Federal Reserve will revert to looking where the inflation goes from here. We go to the next slide. Again, this illustrates what I was talking about. We have the overall inflation rate. Again, I would look more at the core. Historically, the core inflation rate that excludes food and energy has been much more stable. When there's been a significant divergence between that one and the headline number, it is the headline number that tends to revert to the core, not the other way around. The PC inflation rate is on the next graph. It's a different indicator that is probably more relied upon by the Federal Reserve because it is a better indication of the actual consumer basket, expenditure basket of the average US household. But they basically tell the same story. Stabilization at unacceptably high levels is no longer rising. However, after the November report, there's clearly some signs that not only has it stabilized, but it is actually now dropping back towards the target. Again, we're still talking about levels that are completely out of the Federal Reserve target, unacceptably high. So there's really no reason yet to call for rate cuts anytime soon at the Federal Reserve. If you go to the next slide. What's next for US inflation? There's a number of reasons to suggest that this downward trend, this mild downward trend that we've seen over the last 2 months will continue. Inflation expectations have eased. The break-evens, meaning that the inflation that markets expect to see 5 years from now has fallen to 2.3%, which is a good number. It's within sight of the US Federal Reserve target. Economic activity softening. This is something that needs to be mentioned, but after the recent developments may not be as much of a factor. The improvement in supply chains disrupted by first COVID and then to a lesser extent by the invasion of Ukraine continue to improve. Not energy prices everywhere are significantly down from their highs. The housing market, which is right now, as of right now, is the main driver of this inflation overshoot, the housing prices in component of the CPI, should reverse to normal, because the one impact that the Federal Reserve hikings have had, the one undeniable impact, is that mortgage rates in the US are above 6%. They peaked close to above 7% a few weeks ago. They're still above 6%. Housing prices in the US are now falling, which is something that probably the Federal Reserve actually likes to see. So this very high housing inflation that we're seeing in the US inflation reports is probably only headed one way, which is down. Also, let's not forget the US dollar is still trading at very high levels. This should be reflected in downward pressure on import prices, which at the margin will also help keep prices under check. The IMF expects US headline inflation to be 3.5% by the end of 2023. Again, this may be an optimistic assessment, and let's not forget that this is still far above the 2% target of the Federal Reserve. If you go to the next slide, the key question is, how does the Federal Reserve, the Open Market Committee, which meets today and tomorrow, to this new prospects for lower inflation in 2023. Chair Powell said in November that it makes sense to moderate the pace of our rate increases. The question is, moderated to what extent and what will they stop? We're probably almost certainly going to see just 50 basis points rate hike tomorrow. And the key to the US dollar reaction will be, what do they say about rates in 2023? Hints of return to a 25 basis point hike in February instead of 50 would be bearish for the US dollar. Any hints that the Fed expects to stop the rate hiking cycle after that meeting will also be bearish. And probably the key rhetorical shift that we could see that could be supportive of the US dollar would be significant pushback against market expectations that we're going to see cuts as early as the second half of 2023. All in all, everything is very finely balanced. It's going to be a very volatile couple of days, but these are the three rhetorical shifts that traders and markets will be very in tune for after the Fed decision tomorrow. And I will hand over the presentation back to Roman.
Thank you, Enrique. So let's move on to the euro dollar and the euro in particular. So looking at the situation in the euro dollar throughout 2022, we could see that the pair has been pressured on numerous occasions. In fact, the currency has suffered from a significant sell-off and has been selling off through approximately February to September. We've moved below parity at level 1.0 in July, and this was the first time since 2002. So what has triggered this move? One thing has been the aggressiveness in tightening from the Federal Reserve. Fed started raising interest rates in March and has been quite engaged in this process. And on the other hand, the European Central Bank hasn't. They started only in July and they started relatively slow. and only in recent months they've turned up the aggressiveness. But right now they are also thinking about perhaps slowing down rate increases. Also, we had some idiosyncratic issues or some particular issues that concentrated in Europe. One thing has been the war in Ukraine, which has resulted in a negative effect on the energy prices. And this in turn has, the spike in energy prices has been negative for the, and weakness of the euro have resulted in a negative shock to the terms of trade and the current account deterioration. Also, this issue resulted in a higher inflation. Also, and this in turn has made the recession risk quite present in the Eurozone. And the recession risk, one could argue, was one of the biggest factors why the euro-dollar moved below parity. However, of late, we have seen a reversal of this trend. This has coincided with a slowdown in the US inflation and with the stabilization of market expectations for the Federal Reserve hikes. Right now, the pair is about 10, or I think after today's inflation data, even about 11% higher than up from its lows. We are seeing that the recession fears in the Eurozone have abated as the energy shortages are seen as unlikely. The EU natural gas storages have recently started to be used. However, the usage started later than typically, 2 weeks later, and right now they are at about 90%, I believe around 88% to be exact. And the ECB in the past few months has been quite hawkish. We've seen rate increases of 75 basis points, and we think that we are going to continue to see monetary policy tightening in the Eurozone in the coming months. And one reason for the monetary policy tightening, something that the European Central Bank cannot ignore, is inflation, which remains very high. The inflation actually reached a record high of 10.6% in October. However, it recently declined and declined more than expected to 10%. Expectations were of 10.4% print. Interestingly, the month-on-month basis, so in November compared to October, prices actually fell for the first time in 17 months, although this fall has been very limited, only 0.1%. And importantly, core inflation, which is seen as a sticky measure of inflation, something that is particularly important for the central bank to determine policy rates, remains unchanged at 5%, which indicates that price pressures have yet to give. So despite early signs that the inflation is decelerating, these metrics are still at rates that are too high, and there isn't enough evidence at this point to stop raising rates in the Eurozone. At the same time, there is a number of risks that could push the European Central Bank perhaps to be more aggressive. One of those risks is the energy situation, and after a period of declines in gas prices, right now, just in recent days and weeks, they've started moving up quite a bit. So the market is expecting that the deposit rate of the European Central Bank will top out at approximately 2.8% next year from 1.5% currently. And the broad expectation is that the ECB will raise interest rates by 50 basis points from current levels this week. Although we think that this 50 basis point increase is a bare minimum, we definitely don't rule out a 75 basis point increase, or at least think that if the doves have upper hand and we have this 50 basis point increase, then the language of communications should be hawkish. Also, the European Central Bank will soon start a quantitative tightening process, or soon meaning in the coming months. We think that it can start in the first quarter of 2023, although expectations vary, and some, for instance, believe that it will be the second quarter. Nonetheless, this could also matter for the rate decisions, because we could get a hawkish QT, we could get a hawkish rhetoric, and in such instance, we may only have a limited rate increase at this point, so 50 basis point. We think that the market is underestimating the possibility that the ECB will tighten more than expected. And in our view, the European Central Bank will continue to raise rates for a longer time than the Fed in 2023, and the rates should be increased into mid-2023. And right now I'll pass on to Matthew.
Yes, thank you very much, Roman, and hello, everyone. Before we move on, we wanted to get your opinion and get all of you involved in today's presentation, as we tend to do during these webinars. We like to have as much interaction with you all as possible. So I'm going to be launching a couple of polls very shortly, and we're going to I'll ask you two quite simple questions. First of which, we'd like to know what you think will be the main drivers of currencies in 2023. And we're giving you 5 different alternatives. First of all, at the end of central bank interest rate hikes, elevated inflationary pressures, geopolitics, growth slowdowns and possible recessions, or China's zero COVID policy. The second question surrounds the G4 currencies, that is the US dollar, euro, Japanese yen, and UK pound. And the question is, which of these G4 currencies do you think will be the best performer in 2023? And so I'm going to launch that poll, or those polls, now. Feel free to answer those at your leisure, whether now or as we go through the rest of the presentation. And we'll recap the answers and the outcome of those polls at the end. I also wanted to mention about the Q&A section. We do have time, or hopefully we'll have time, for questions at the end. If you do have any questions, either now or as we go through the rest of the webinar, please feel free to pop them in the Q&A function on the Zoom app. And again, we'll get round to answering all of those at the end of the webinar. With that out of the way, we're going to move on now and briefly talk about sterling before I move on and talk about our general outlook for 2023. And the pound has experienced one of the most volatile periods that we've seen among major currencies in the last few months or so. Sterling collapsed to a record low level against the US dollar, around the 104 level, following the mini budget disaster from the Liz Truss government in late September. Since then, volatility in the pound has remained high, although we have seen quite a significant rebound in sterling since the peak of the downturn. The initial move higher was driven predominantly by U-turns from the UK government on Liz Truss's widespread tax cuts. We've also seen a general stabilisation in UK financial markets in the past couple of months. First of all, as Prime Minister Rishi Sunak was appointed and Chancellor Jeremy Hunt, both seen as a relatively safe pair of hands for both the UK economy and financial markets in general. Government borrowing yields, bond yields, I should say, have fallen quite sharply from their peak. The 10-year gilt yield is down around about 125 basis points from the peak in the immediate aftermath of the budget announcement. That's been perceived as positive for sterling, given it has calmed markets and removed a degree of the political risk premium attached to sterling. For its part, the Bank of England has also continued to raise interest rates at a very aggressive pace. Another 50 basis point hike is expected at its meeting on Thursday. I'm going to talk about that in a little bit more detail on the next slide. With the BOE expected to raise rates at least through the first half of next year, probably deeper into the first half of 2023. A final key point I would like to mention is the general resilience we're seeing in UK economic data. Most indicators of economic activity are holding up relatively well. The PMIs of business activity in particular are only showing a relatively shallow downturn, while other prints, the October GDP print, for instance, came in much better than expected. That has caused investors to believe that the downturn in UK economy next year may not be quite as bad as initially feared, which again has supported sterling. But what about Thursday's Bank of England meeting? Well, we think that a 50 basis point rate hike is likely. The MPC raised rates by 75 basis points in November, but we think that was a one-off and largely in reaction to the mini budget announcement. 50 basis point hike looks like a done deal, but the vote on rates is unlikely to be unanimous. At the last meeting in November, we had a three-way split whereby 7 members voted for a 75 basis point hike, 1 for a 50, 1 for 25. We think there's a decent possibility that this week we could get an unprecedented 4-way split. And we think there's a decent chance that we see perhaps 2 or 3 members vote for a 75, 4 or 5 for a 50, and maybe 1 each for a 25 and no change in rates. That would be, as I said, unprecedented. I think that's the first time that the MPC would have ever had a 4-way split in its voting pattern. If we get a scenario whereby we have a 4-way split, or at least a divided committee, muddled communications, which has been a common trend in the last few months, and perhaps more rhetoric that suggests the Bank of England may not raise rates as aggressively as currently priced in, then that could present a downside risk to sterling in the near term. Having said that, we still don't think a 75 basis point hike can be completely ruled out. A lot will perhaps depend on tomorrow's UK inflation numbers, which we'll be watching very closely. Wanted to talk now a little bit about our view on the global economy for 2023, particularly whether or not we may see recessions among some of the major economies. And macroeconomic news and indicators that we received of late have generally, broadly speaking, deteriorated. We are seeing signs of slowdown in some of the main indicators of economic activity, but they are holding up relatively well under the circumstances and indicate that the downturns may not be quite as bad as first feared. The PMIs of business activity are the most timely indicator of economic activity that we have. Any number above the level of 50 represents expansion, below 50 is contraction. As you can see from the charts on the top right-hand side, you can see that these indices for the G3 are now below the level of 50, albeit only modestly and only in line with a very mild downturn in economic activity. Consumer business investment sentiment indices have generally worsened this year. Indicators of consumer sentiment have fallen to multi-decade or record lows in many instances, particularly in the likes of the UK, Euro area, for instance. This suggests that there is still a high degree of pessimism in the economy, which does not bode particularly well. Neither does the inversion in the global yield curve, which has inverted for the first time ever. This suggests that investors believe that long-term rates will now be below near-term rates, i.e. investors anticipate lower growth and therefore lower inflation and lower rates in the future. This has tended to be a pretty good barometer and guide in the past as to whether we are due a recession. Indeed, every technical recession in the US in the past 50 years has been preceded by an inversion in the US yield curve. So that does not bode particularly well. I would stress 2 points, however, the first of which is that we are not at levels that would indicate deep recessions. As I said, the PMIs are holding up relatively well. GDP prints are performing generally better than expected. And secondly, we are seeing a bit of a discrepancy between the soft indicators of economic activity, such as the sentiment indicators, and the hard indicators of activity. Broadly speaking, we have seen a general outperformance in these hard indicators, as represented by the G10 Economic Surprise Index. Similarly to the Inflation Surprise Index, this shows how indicators of economic activity are performing relative to expectations. You can see that this index is now back in positive territory. So that's a general indication that economic data is coming in slightly stronger than economists had anticipated. Having said that, there are still a number of uncertainties that are clouding the outlook for 2023, and we've listed perhaps 3 of the main ones in this slide. First of all, monetary policy remains very tight. We have seen one of the most aggressive paces of interest rate hikes for many years, as Enrique mentioned, in many cases of all time. And there is no prospect really for interest rate cuts anytime soon. We don't expect interest rates to be cut, certainly in the major economic areas, until late 2023 at the very earliest, possibly into 2024, depending on the data. So interest rates to remain very high for a pretty prolonged period of time. Inflation rates are easing, as we've talked about, but again, remain very elevated. There is no prospect of returns to central bank inflation targets anytime soon. That is likely to continue to weigh on consumer spending activity and keep interest rates at a relatively high level. And geopolitical tensions and concerns are not likely to go away anytime soon, particularly the war in Ukraine, which, as we all know, showing no signs of ending just yet. That could potentially present a little bit of an upside risk to energy prices. We wouldn't rule out additional spikes in energy at some point in 2023 should geopolitical concerns and tensions take a turn for the worse. So again, that could present a risk to the global economy next year. The IMF has once again revised lower its global growth forecast. It's penciling in expansion of 2.7% in the global economy for next year. While clearly much slower than we've seen in the last couple of years, this is a return to slightly more normal levels of growth. And indeed, we think that most areas or many areas could hold up relatively well. Emerging Asia, for instance, is expected to post pretty strong growth of around 5%. Biggest risks to growth though, and if we look at the latest Bloomberg Pulse survey, suggests that investors are fearing stagflation or a deflationary recession. So high prices, elevated inflation rates likely to continue to drive the global economy and the performance of economies into next year. But having said all that, there are reasons to be optimistic and reasons to suggest that the downturns may not be quite as bad as some economists fear. And we've listed a number of reasons as to why we think that's the case. First of all, we think that the fallout from the energy crisis will be relatively limited. We've seen quite a significant downward movement and retracement in natural gas prices in Europe, in the US. It looks likely that shortages and rationing of energy will be avoided in Europe, at least over this winter. That removes quite a significant downside risk, we believe, to European and global growth. Supply chains are normalizing. We're seeing, for instance, a quite sharp drop in freight rates. This represents the price at which cargo is transported from one place to another. That is now, as you can see from the global freight rate index, returned more towards levels that we saw prior to the pandemic. That should limit the impact on inflation. Inflation itself also appears to be peaking in many major economic areas, or at least we think that a peak is on the way in the next few months. Labour markets as well are also holding up very well. This is a characteristic that is unlike previous downturns in the past. Labour markets are strong. We're seeing very low levels of unemployment, in many cases just above or still around either multi-decade or record lows. Nominal wage growth is also relatively high in most instances, and we're continuing to see high levels of job vacancies that are far outstripping the number of those that are unemployed. Households should continue to be well supported by government support as well. We've seen a huge amount of fiscal support from a number of the major governments around the world during the cost of living crisis, which we think should support consumer spending, while high savings accumulated during the lockdowns remain evident and again should support household demand. Lastly, and not to be underestimated, China is in the process of unwinding some of its strict zero COVID protocols. And we've seen a removal of some of these lockdown measures in the last couple of weeks, we expect that to continue into next year, which again should support activity. I'll stress again, we think the downturns are probably on the way, but these recessions we do not believe will be quite as bad as many people are anticipating. But what can we expect and what can we look out for 2023? We've covered most of these points during the webinar so far, but it's good to sort of consolidate and recap what we think will be the main drivers of currencies and financial markets in 2023. First of which, we think that most of the major central banks are very close to ending their hiking cycles, and indeed we think that most will be done in the first half of next year, if not sooner. There is a good chance that we could see a number of them end their hiking cycles in the first quarter of 2023. An easing in inflation rates is likely to justify the move away from this tightening in monetary policy. As mentioned, we've begun to see signs of an easing in inflationary pressures in a number of major economic areas, notably the US, Canada, for instance. We think that these inflation rates are likely to follow suit in a number of the other major nations and economic areas in the coming months, for many of the reasons that we've already discussed. Global downturns are likely on the way, we believe. We think that technical recessions in many of the major nations are probably inevitable. Certainly we expect growth to slow quite significantly. But as I stressed in the last few slides, we think that these downturns will be both shallow and relatively brief. And China, we think, will end its zero COVID policy at some point in 2023. As I said, we've already begun to see signs of an easing in these measures and protocols after some mass protests. We think that these measures will likely be unwound further in the coming months, which should be good news for the global economy. And combined with the end to these hiking cycles among the major central banks, we think this presents a positive and encouraging environment for risk currencies, particularly emerging markets and emerging market currencies, which we think still have some ways to go in their recovery against the US dollar. As I said, we think the hiking cycles are soon to begin winding down if they haven't done so already. Most of the major central banks look set to be done raising rates either in Q1 or Q2 next year. We think there's a very good chance that the Federal Reserve could now end its hiking cycle at its March meeting, particularly following today's inflation miss in the US. Like the European Central Bank, Bank of England may follow suit not too far after, perhaps towards the middle of 2023. While others in the G10, the Bank of Canada, may perhaps have already ended its hike cycle. Reserve Bank of Australia, Swiss National Bank, for instance, may only have one or two more hikes at most left in the tank. So interest rates to begin normalizing or to begin held steady at relatively high levels. Inflation rates as well, we also think will start trending lower. We started seeing signs of a normalization in energy prices, gas prices, for instance. Commodity prices have fallen. As mentioned, we're seeing improvements in supply chains, which should again ease pressure on inflation. Inventories have built up, shipping costs have declined, as we showed you a few slides ago. And of course, consumer demand is set to weaken. Actually, recessions may be a very good way in order to bring down inflationary pressures. So while we have a little bit of hardship in the near term, that may actually be good news for the global economy in the more longer term. A return to central bank targets, though, as we've mentioned, remains some way off. We're not expecting interest rate cuts until late 2023 at the very earliest, perhaps even later than that. And that should provide some relief, as I mentioned, for emerging market currencies. We continue to see most EM currencies trade at relatively cheap levels. Once we start seeing signs from the Federal Reserve that it may perhaps be nearing the end of its hiking cycle, we could get those signals tomorrow. That could present a conducive environment for some pretty decent rallies in these emerging market currencies, which we think are at very cheap levels. And lastly, well, what do we think for the global economy? Again, as you've mentioned, we think the recessions are likely on the way in many major economic areas next year, but we think that these downturns will be relatively mild and not quite as bad as priced in currently by markets. A number of reasons as to why this is the case. To recap, we think that labour markets are in a very good place. They're very strong, unemployment's low, job openings high, nominal wage growth is pretty good as well. Governments are continuing to provide ample fiscal support during this cost of living crisis, whether that be energy bill freezes, one-off payments, VAT cuts, for instance. That should support consumer demand, as should the high levels of savings that were accumulated during the pandemic. China looks likely to continue reopening its economy. We're likely to get more news on that in the coming weeks. And financial markets are very well capitalized. All in all, as I said, we think that the global economy will hold up better than expected next year and better than priced in by markets, which could potentially be good news for risk assets, emerging market currencies in particular. We expect to perform well against the US dollar, which we expect to continue retracing from current levels. The key, though, I would suggest for next year is the extent to which we continue to see inflation overshooting expectations and overshooting central bank targets. If we see a more swift return back to more normal levels, that could bring interest rate cuts into view a little bit sooner. Whereas if we were to see elevated levels of inflation throughout next year, again, it would mean no prospect of rate cuts. It would mean perhaps a worse performance in the global economy next year, which could trigger a few more safe haven flows into the likes of the US dollar. But that is everything from us in terms of the content that we would like to cover. Again, as I mentioned earlier, if you do have any questions on anything that we've covered so far during the webinar, please feel free to pop in the Q&A function on the Zoom app, and we'll be more than happy to get around to answering those in the next few minutes. But we did have one question, which is on, we'll be able to share the material with attendees. We absolutely will do that. So look out for an email in the next couple of days or so, and we'll send all these slides over to you in PDF format. Is there any other questions from anyone? Here we go. We do have one. The first question is, given the current situation, do you see the euro against the US dollar getting stronger or weaker in the first half of 2023? Enrique, would you like to take that one?
Yeah. Especially after today's data, I think that it's not at all clear that European inflation will start performing as well as US inflation, meaning it's not clear that European inflation will start coming down the way US inflation is coming down. So I expect to see a situation in which the Fed can afford to take its foot off the brake, whereas the European Central Bank still has a lot of work to do, and in fact has to maybe accelerate the pace of hikes versus what markets are predicting. So I expect that rate differential to get between the US and the Eurozone to get compressed in favor of the Eurozone, and that should support the Euro. So I think that, I don't know what Matthew and Roma think, but I'm definitely quite positive about the Euro's prospect in the first half of next year.
Yeah, I very much agree with that. I think we're on the similar sort of page. And I've been given a good reminder here to recap the results of our poll that I launched 20 minutes or so ago. We asked you what will be the main drivers of currencies in 2023, and it's very much a split between 4 of the 5 options. Unfortunately, only one person went for China's zero COVID policy, but among the other 4, we have 36% for growth slowdown and possible recessions, and around about 20% each for the other 3, which is very interesting. So thank you all those for filling out that. And our second question was, which G4 currency do you think will be the best performer in 2023? Interestingly, almost half of you have gone for the US dollar, so slightly against our house view. 36% the euro, only 7% the yen, and 10% sterling. So most of you expect, or at least half of you, almost half of you, expect the US dollar to outperform next year. So again, thank you everyone for answering and participating in that poll. We have another question, which is, outside of the Ukraine war, what are the other possible geopolitical risks that could play a role in Europe, Turkey and Hungary, for example? What do you guys think? Is there any additional geopolitical risks, not just in Europe perhaps, but globally, that you see next year?
Roman, why don't you answer that? Given you're center to you're closer to the action, so to speak.
Yeah, I mean, starting with the war in Ukraine, I think that its effect has been continuously it has been continuously less important for the currency market. We've seen instances when the sentiment improved after we saw some advances of Ukrainian forces in retaking their land. We also saw some risk in the euro-zloty exchange rate after the rocket landed in Poland, a rocket that has flown from the conflict. Nonetheless, I would think that this particular geopolitical aspect should be continuously less important for the currency market. And when it comes to other risks, I don't really see anything of a similar significance happening in 2023, or even of a smaller significance that would be still important for the currency market. Obviously, the geopolitical tensions are continuing practically every year. There is something going on. We even today had some information from the border of India and China. We also have some information from Serbia and Kosovo. However, I don't think that any of the issues that are mentioned here or any other issues will result in a significant pressure on the risky currencies, or that will have a significant effect on the exchange rates at all. One thing that could have an effect and could have a strong effect is if we saw China deciding to retake Taiwan by force. However, I don't think that anybody is really expecting that to happen in the near future. This certainly wouldn't be my expectation. Not sure if Enrique and Matthew agree, but this would probably be the only real thing that could actually influence the situation, but I don't see it happening.
Great. We have a couple more questions. One is on potential events that no one sees coming in 2023. Nobody predicted COVID, nobody predicted the war in Ukraine. So is there any other major events that you predict that perhaps no one else sees coming? I think that's a particularly difficult one to answer. I think there's a reason why no one sees them coming, because they are very difficult to call. I mean, I think perhaps maybe a risk factor that we could see in markets next year is not our base case scenario, but if perhaps we're wrong, the market's wrong about inflation, or actually we start seeing a faster return to more normal levels, we start seeing more inflation reports like we did out of the US this afternoon, where we see downside surprises. Maybe that starts bringing rate cuts into view sooner than expected. But aside from that, I think it's very difficult to come up with any sort of answer on this. I don't know if you guys have any other response to that.
It's super hard to predict unpredictable stuff in general.
It is. It makes it very difficult for us, unfortunately.
Yeah, it's I would say the opposite. The idea that everybody's assuming that inflation is going to go back to normal without rates ever having to go above inflation levels. Let's not forget that everywhere in the G10, headline rates, overnight rates, are still considerably below inflation. So I think that the risk that concerns me, and it's just a risk, is not more simple scenario, is that that's not enough, and that maybe inflation stabilizes at the current levels instead of coming down.
And we have another question on currency corridors. I think this is perhaps one that we could maybe move past. I don't think that's necessarily a sort of area which is our expertise. So we wouldn't want to give maybe sort of an uneducated answer as to that one. There's another one on the possibility of more strikes in the UK next year, and whether this could be a significant risk factor for sterling next year. I would say there is very much a possibility that we continue to get more strikes in the UK. For those that are unaware, there are train strikes in the UK at the moment. There are nursing strikes, there are all kinds of strikes left, right and centre. I think with cost of living crisis, with UK inflation expected to remain very elevated next year, very much a possibility, but we have not seen that reflected at all in the value of sterling, and I wouldn't expect it to be so next year. I think it has a very negligible impact on the overall macroeconomic situation. So very much an insignificant risk for currency markets. Well, we have another one, which is how would you see a possible development of a third world country such as South Africa in first quarter, second quarter of next year? So South African rand, what are your views, Enrique and Roman, for the first half of next year?
I think that in general, emerging market, the outlook for emerging markets is quite positive, and I think that today's report, inflation report, and the almost certain Fed pivot that we're going to see tomorrow, it just reinforces that idea. We have emerging markets in general have been in this cycle much more aggressive than G10 countries in dealing with inflation. The hike rates, South Africa included earlier, harder and faster. And so I think that now that inflation seems to be either stabilizing or coming down everywhere, we could see additional outperformance in all these main emerging market currencies. Rates over there are still considerably higher than in most of the G10, and inflation seems to have peaked in most of those countries. So if you combine that with increased risk appetite from investors as the Federal Reserve steps off the brake, I think the environment in 2023 in general is quite positive for emerging market currencies.
Yeah, I think rand is already performing better than we expected, and I don't see why it would suddenly start performing worse. So I think that we should expect a further strength in the currency. At least this would be my view.
Excellent. We also have another question on the climate crisis and its potential impact on food prices, inflation and exchange rates. What are your guys' views on the impact of potential climate crisis on food prices, inflation and currencies?
Yeah, I think we are already seeing some shocks in that department. For instance, looking at the Central and Eastern European countries, in recent months, the food inflation has quite skyrocketed. In fact, we see the monthly increases that we haven't seen in years or decades. So this certainly is an issue that is arising. It's also arising because of the situation in the energy markets. And I would think that the risk to food inflation is perhaps the biggest risk to inflation that I would see in the coming, not only the 2023, but the coming years. This is my view. I'm not as worried about the situation in labor markets or the wage growth. I'm actually a bit more worried about the situation in the food prices, in trade. There is just so many factors that could affect this space that I think that it is certainly something that to be worried about. Even war in Ukraine proved that it had the capacity to increase the food prices and also the fertilizer prices to a significant extent. I think that we cannot rule out further increases that have already been quite substantial.
Excellent. We have a similar question with regards to taking advantage of climate issues with respect to currencies and commodities. I mean, I think building on sort of what Roman said in terms of, sort of food price inflation, but this is certainly as a broad global issue, but there are some small idiosyncrasies whereby some countries are more reliant on imports of food and more sort of sensitive to increases in food price inflation. I think that those are the countries that we should be looking at with regards to the potential climate issues and the possibility of maybe inflation remaining slightly more elevated in those countries than elsewhere. I think that would be a certain point to highlight, and that's when we could start seeing impacts on currencies for those countries. We have quite a long question here. I'm just going to sort of briefly go through this. So talking about inflation around 4.5% in January, should we start seeing a decrease from next year?
I think this is about base effect, Matthew.
Yes, I think so. I think this is to do with the base effects starting to come into the inflation prints, which I think, yes, I think we should start seeing that in 2023. We start seeing that we've had very high levels of inflation this year. It makes sense that given that the high base effect, the inflation prints of the year-on-year inflation prints for next year will naturally be slightly lower. I think that's when we start looking at, as Enrique was talking about earlier, we start looking at, say, annualized 3-month core inflation. I think that perhaps provides a better metric, better indicator as to inflationary pressures than the annualized numbers may do.
Yeah, I would certainly agree with that. And I think that we already can see some base effects, for instance, in the core inflation data in the US. But also with regard to base effect, I think it is hugely dependent on the country, on the inflation rates in particular periods. So in some countries we are already seeing this inflation, and in some countries this will start happening at the beginning of the 2023. In some countries only at the end of the first quarter or in the middle of the 2023. So it is significantly dependent on the country and on the region when this base effect will be significant enough to push the inflation down. But in general, I think that this should support this inflation. Yes.
One thing I would add to that is that, for instance, in the Eurozone in particular, the core index, inflation index, is not very good because, as the European Central Bank itself acknowledges, it does not take into account the impact of higher house prices and rents into housing. The weight of housing is less than 8% of the index, which is very low. If the Eurozone inflation index accounted properly for housing costs, inflation would be a full point higher. Core inflation would be, and regular inflation would both be a full point higher. So whereas we're seeing the beginning of a moderation in core inflation in the US after the Federal Reserve hike raised by 425 basis points starting tomorrow, it's not clear that the European Central Bank, that has hiked less than half as much, can expect to see the same impact on its core inflation going into 2023. So to me, 2023 is going to be the year of divergence, where inflation does not go down or up by the similar amount everywhere, and the different monetary policies and macroeconomic situations of the different economic areas will be a bigger driver of how inflation does in relative terms in all the economic areas.
Yeah, I mean, those idiosyncrasies can already be widely seen in emerging markets. For instance, if you look at Central and Eastern Europe, we have inflation prints of around 20%. If you look at Asia, it's not uncommon to see inflation of 2%, 3%, or maybe slightly more. In Latin America and Brazil, inflation at 6%. So it is hugely dependent on the region, and the moment when the base effect will take place will be hugely different.
Excellent. I think that's all of the questions done and answered. So thank you for all of those that submitted those. We're a little bit run over with time, so I think we'll wrap things up there. But again, thank you all very much for joining our webinar today. Be sure to look out for any communications with regards to our next one, which we'll look to do at some point early next year. But other than that, again, thank you all very much for joining. I hope you have an excellent Christmas and New Year period. Thank you, everyone.
Thank you.
Thank you, everyone.